there are a number of nagging things here that I don't think are properly appreciated, but that hasn't slowed down headlong rush into stocks. But bear in mind that historically, when you get the greatest conviction that there's no downside risk, you're usually at a peak.
Dr. Gary Schilling, president of A. Gary Schilling Co., and also the publisher of the popular monthly newsletter Insight, which is available at agaryschilling.com or also by calling the toll-free number 1-888-346-7444. Dr. Gary Schilling, it is an absolute honor to welcome you back on the show and great to see you again.
Glad to be with you.
Well, I'm so happy to have you, Dr. Schilling, and you were a huge hit with the audience last time, and we learned so much from you. And so it's been since November. A lot has transpired in that time. So, Dr. Schilling, I would love to start where I always start with my guest, and that is to get their, big picture macro view, the framework in which they're looking at the world today. And again, one of the things about this show, Dr. Schilling, take all the time you need to set the table, if you will, when it comes to that economic picture.
Okay. Well, we're obviously dealing with an economy here that is looking like it isn't going to go into a major recession, at least not immediately. Now, that's never certain, of course, but we haven't had one, and this is highly unusual. Soft landings, and I define a soft landing as a time when the Fed tightens credit and then eases and no recession. You don't know that they're through tightening until you get an easing, and if that's the case and you have no recession, then you could say it's a soft landing in the usual definition. Now, the only time in the entire post-World War II period we had one was in the mid-1990s. Every other time when the Fed jacked up interest rates, a recession followed. So this is a highly unusual kind of environment. Are we home free yet? You don't know. But it's looking that way, at least to most people. But there are still some troublesome signs out there. And again, you look at things that normally are associated with recessions, inverted yield curve, with short rates above long rates. When the Fed tightens credit, they jack up short rates. It spills over to long rates, but never one-to-one. And when that happens, in the past, you've always gotten recession, no exceptions. Another one is leading indicators index, things like stock prices and new orders for durable goods, things that normally precede general economic activity. And that's been negative for some months. And again, that's got a perfect record in the post-World War II period of anticipating recession. So, maybe this is going to be an exception, but they say there's some kind of nagging factors there. Another thing that I think is of concern is the amount of speculation that we've seen. It's interesting. You've got the Magnificent Seven. And by the way, I hope most people realize that that's sort of named after a movie, Magnificent Seven, of these seven gunslingers who rescue a Mexican village. And that actually, don't mean to get too much history, but that was followed the seven samurai, seven Japanese samurai back in, over 100 years ago who rescued some villagers. But anyway, that was the seven stocks. Now that's gotten down to now they're calling the Fabulous Four. It isn't the Magnificent Seven because you had some of these, Tesla and so on, that have not lived up to the expectations recently. And that narrowing of stock market involvement, I think, is always a troublesome factor. I can remember very well when you go back to the early 1970s, and you had this Nifty 50, they called them, these stocks, and they called them one decision stocks. One decision, you only bought them, you had never had to sell them. And it got to a narrower focus. You finally got down to the point you had Disney and Polaroid and Winnebago, and what really told me at the time was when people are so concentrated in their interests, investors are really in effect saying that the rest of the economy, as reflected in the rest of the stocks, is not really that interesting. Very, very negative, as a matter of fact. And so it's that narrowness of focus, which I think tells you that people are not very happy about the overall economy. So you had this narrowing of focus now, or say down to the fabulous four from the magnificent seven. And of course, you've also had a lot of speculation. You've had this in the cryptocurrencies, despite the collapse of FTX and, Sam going to jail for 25 years. I mean, this is not a very healthy kind of environment in my estimation. So there are a number of nagging things here that I don't think are properly appreciated, but that hasn't slowed down headlong rush into stocks. But bear in mind that historically, when you get the greatest conviction that there's no downside risk, you're usually at a peak.
Fascinating. So what I'm hearing is that it's not really a healthy economy when you look at the bigger picture.
No, that's right. I mean, and the economy is, of course, is highly dependent on employment, and employment gains are they're still robust, but the indications you look at layoff rates and quit rates. When people are convinced there are plenty of jobs out there, they're very willing to quit. They have backed off from that. A number of these factors that typically suggest that the labor market is not all that robust, at least at present, are sort of creeping up. So does this mean that we're really getting ready for a big decline? Remains to be seen. But the indications are not all that healthy. This is not a situation where you'd say, hey, we've cleared the decks, everything is fine, full speed ahead.
It's so interesting to me, and I'm so glad to have you back on, because I was just thinking, the Federal Reserve, raising rates 500 basis points in less than 2 years. You would think that it would have pushed us into a recession. Why didn't it? Why? It seems a little unusual, right?
Yeah, I think there's one of the key reasons is because employers have been very reluctant to lay off people. When you had the labor shortage days back during the pandemic, there were shortages of labor, and so employers were very, very anxious to hire and hang on to people. Well, when they've done that, they're very reluctant to lay them off, even as their sales and profits don't live up to expectations. So I think it has resulted in a delayed effect, if you will, in the employment picture. And that's very important to the Fed because, if you have a lot of jobs, you're producing income, and people are spending it. But we just got numbers for last month for income and spending, and you had a much greater increase in spending, 0.8%, than you did in incomes, 0.3 month over month, and it suggests that people are really stretching, and that's kind of interesting because earlier you had a lot of money pumped into the economy in response to the COVID epidemic, all these extra checks that everybody got, and that money has largely been spent. So, and what we're seeing now is people resorting to borrowing, and you see credit card borrowing and delinquencies rising. In other words, people have not really accepted the fact that they've pretty much spent the extra money they got that was pumped out in response to the pandemic. So I think you're in a kind of a precarious situation.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. It also makes me wonder too, Dr. Schilling, because you point out the consumer, are we also seeing a bifurcation in the consumer, like the haves and the have-nots? More people are stretched, borrowing more?
Yeah, that's true. Now, that's always true to a certain extent. I mean, you've got the people on the top who have plenty of money, but their spending is not particularly changed in relation to their incomes or asset values. I mean, stocks go up, okay, it makes them feel richer. They spend a little bit of it, but for every $100 in increase in stocks or real estate in their net worth, they spend $2 or $3. It's a relatively minor effect. It's the people on the bottom and even increasingly in the middle that are the ones that are really, really stressed, and that's what we're seeing now. And I think a lot of those people are resorting to credit card borrowing, but you're absolutely right. There is a bifurcation here.
Mm-hmm. I had you on in November, and then I'm thinking like back in December, I guess there was a lot of expectations on the street about Fed rate cuts this year. Some were expecting 6 rate cuts. A lot has changed in the past couple of months. Going back to the Fed, what is kind of your outlook there, especially around interest rate policy?
Well, the Fed obviously jacked up interest rates when they were concerned about an overheating economy and inflation. Now they've paused, as we all know, and the expectation is they're going to cut rates. Now, earlier, the expectation was they were going to cut rates 6 times this year, although they said, according to their forecast, that it was only going to be 3 times. Well, I think people have cooled down in their expectations, and it's now down to 3 times. And there's some suggestion that maybe it's going to be even less than that, because inflation, they talk about that last mile, getting back to this 2% target that the Fed has. Now, I've never been quite sure why the Fed has a 2% target. I think they instituted it back in the days when they were worried about deflation, back before the pandemic. And I think it was because they worry about the debilitating effects of deflation, where people wait for lower prices and they don't spend, and inventories build up, and excess capacity pushes prices down. It can be a vicious circle. But in any event, they instituted this 2% target, and they're sticking to it. They're really locked in there. So the question is, right now, what's it going to take to get there? And I think it's becoming increasingly clear. And part of this is simply the numbers here. Most short-term forecasts are simply projections of whatever's going on right now. You have to recognize that and that's one of the things that I try to concentrate on. I think that's my job, is trying to separate the wheat from the chaff, if you will, to pick out what is important, what has lasting implications, as opposed to what is the passing fantasy. There's always going to be something that's earth-shattering. You never saw a newspaper that has a blank column on the front page saying there's nothing worth writing about. You never saw a media account where they just say we're going to have 10 minutes of silence because there's nothing worth reporting. Oh no, there's always got to be something, and it's going to be earth-shattering. And that's one of the things that I try to think hard about and separate out and to say, what is important, what has lasting implications. And I think right now we've swung back and forth here. Right now, I think the concern is that maybe inflation isn't going to come down that quickly, and the Fed may not cut 3 times this year, and maybe some people saying maybe not even at all. But the question is, why does the Fed cut rates? The Fed doesn't do this in a vacuum. They just don't say, hey, we want to cut rates because that's good for stocks. That's going to make everybody very happy on Wall Street. They do it because they think that the economy is in a position where they can institute lower rates, where it's not a question of surging inflation. If anything, it's a risk of going the other way. And so that's what you have to keep in mind. And what is it that the Fed is looking at? What induces them to move interest rates up or down? And right now it looks like they're kind of saying, well, maybe we ought to wait longer. The economy is moving along. There's no immediate rush. And the last thing they want to do is cut interest rates prematurely, have inflation surge, and then they got to come back and really kill the economy to reestablish credibility. And that's the last thing they want to do.
Yeah. And so it sounds like the inflation problem has not been beaten. Do you see it not being beaten anytime soon? Just want to clarify.
Yeah, I don't think so. I think it's a tougher slog than many people thought. And of course, you had this pattern of inflation, in March of 2022, the CPI year over year 9.1%. Okay, it's come down dramatically from there, and of course the easy expectation is that it'll just continue all the way down to the Fed's 2%. But again, it gets tougher and tougher, and that's particularly true of service inflation. Goods inflation very much dependent on whether you've got excess supply, and we've gone from shortages and supply chain problems to the reverse. But services are a very different thing. You don't see many, when's the last time you saw services or medical services or travel services or anything like that actually reduce prices? They're very sticky, as economists say. They don't move up or down that rapidly. But service inflation now is running 5 or 6%, and services account for about 2/3 of consumer spending. Goods are a much smaller chunk. So for service inflation to come down and satisfy the Fed's conviction that they're going to get to this 2% on a sustainable basis, I think we got a ways to go there.
Yeah, certainly. One of the things about you, Dr. Schilling, is you are adept at finding, hidden flaws. And so kind of stepping back, what's on your radar right now when it relates to kind of finding hidden flaws out there?
Well, sometimes the radar is a little cloudy, but yeah, I think that right now I'm concerned about the high degree of speculation that we still have in a lot of areas. Whether it's Bitcoin or cryptocurrencies or some of these areas. And again, when you talked about this earlier, but when you see people concentrating on a smaller and smaller and smaller group of stocks, they're really in effect excluding everything else. And it's easy to say, what are they interested in? But I'm saying, okay, what aren't they interested in? What are they really rejecting? And that's really the bulk of stocks that represent the bulk of the economy. I mean, I'm not saying that some of these things and so on are not significant pieces of the economy, but they're not. They're not the huge amount. If they were, productivity growth would be growing in leaps and bounds, and it isn't. The whole idea is that AI is going to make productivity growth a lot easier. Are we all even going to be employed, or we're going to have a machine replacing us all? That's a great pipe dream. But the point is that these areas, although they garner a tremendous amount of investor interest, they are really pretty small in terms of the economy, and also they take a long time to get big enough to move the productivity needle. And I think that's, of course, the latest run is AI. But look what's happened to electric vehicles. I mean, you go back a year or so, and now it's just hotter than red hot. And what happens? That's really cooled off. I mean, people are deciding, hey, wait a minute, I don't know where I can recharge these things, or the battery's going to last. and the costs. And the bloom is off the rose there. And I'm not saying that they don't have a future, but what's the growing area? It's the hybrids. It's not the electric vehicles, because people say, my goodness, I get down the road 50 miles and I'm absolutely stuck with a dead battery and no charging station in the area. And if I can find one, it's going to take a couple hours to recharge. So you're seeing a number of these speculative areas that really come and go. And that's one of the things that I try to concentrate on and say, what are the areas that are genuinely new, rare, strange, and exotic that are going to have lasting impact? And what are the ones that are speculation? Now, it doesn't mean that people can't make a lot of money on a short-term basis out of these speculations. People have done that with electric vehicles. They've done it with AI, other these hot new technologies. But you got to be pretty handy in getting in and out of those things, because as we've seen recently, they really don't last forever.
When you say you focus on areas that are going to have lasting impact, what are those areas for you right now? Well,
I think that we're dealing with a situation where attractive areas, and these are in a macro approach. We're very much top down. We start off with the political, economic, financial spheres, develop a forecast, and see what investment themes fall out of that, and that's what we use in managing the portfolios that we oversee and our forecasts and what we put in our monthly newsletter Insight to advise our clients. But the point is that I think right now I like the dollar. I think the dollar is is really very sought after. If you look around the world, there's really no option to the dollar. And you look at, for example, China. China is now in considerable trouble. Their growth has dropped off, and they don't seem to be able to reignite it. And they've had this massive real estate boom and bust. And the Chinese authorities, they have no intentions of bailing out real estate. Their famous expression is, houses are to live in, not to speculate. Very different than what we see back with the subprime mortgage bonanza in this country, which obviously collapsed. But they have a different attitude on that. And, the Chinese authorities they're very willing to let the economy drift along. I mean, they don't want to have unrest. They don't want a Tiananmen Square situation where the regime is threatened. But other than that, I think people will realize that in China, economic growth as we see it, that's not their top priority. Top priority in China is keeping control. And that's what Xi, who's basically made himself president for life, that's what he's interested in. And, they stifle all opposition and everything else. The interesting thing about these top-down regimes is they work until they stop. There's no way to change them peacefully. That's one of the reasons we're very high on India right now, and it's got a lot of problems. But it is a democracy, and you can change it coming up to election in India. Modi's probably going to win easily, but at least there's a way of changing it. You look at China, and there's no way. When you got a top-down regime, the guys on top are not going to voluntarily relinquish their control. So the only way it happens is they get tossed out. And I've looked back historically, 5,000 years of Chinese history, dynasty by dynasty by dynasty, and that's what happened usually because of civil unrest. And you get these situations where they toss out a dynasty and you bring in the next one. But that's that's a real problem in China, and I think we don't tend to realize that. We tend to look at everything from Western eyes, and particularly from American eyes, and we don't realize that economic growth, as we see it, is not that important in China. And China is the second largest economy in the world, and obviously, as their economy falters, shows very slow growth, it means their demand for commodities are faltering. It means that they're putting a lot more emphasis on exports. That's the way they promote growth when domestic economy is weak. And where do those exports go? They go to North America and Europe. So it means more competitive pressure there. But I think you got to look at a lot of these things on a global basis.
So recapping some of the investment themes I'm hearing from you, long the U.S. dollar, earlier in the conversation, avoiding those speculative areas, I guess the Magnificent Seven, Fabulous Four, AI, crypto, going from China, switching from China to India. You favor India.
Yeah.
What are the other themes that are top of mind for you?
Well, I like U.S. Treasuries. They're a safe haven, and inflation is coming down now, more slowly than the Fed would perhaps hope. But it is coming down, and it's the diminution of inflation that I think is important, as opposed to the Fed. Again, I mentioned earlier, the Fed doesn't operate in a vacuum. They don't just sort of say, "Oh well, let's cut rates today. It'll make everybody in Wall Street very happy." Oh no. That's the last thing they want to think about. So I think that we're looking at a easing of inflation, and that's the biggest driver of interest rates. We've done work on this, and if you look at the entire post-World War II period and look at Treasury bonds, long-term Treasury bonds, there's a 70% correlation between year-over-year change in the consumer price index and Treasury bond yields. Now, that's amazing. You think of all the other factors that could affect them, wars, economic crises, legislative action, what's going on abroad. But the primary determinant is inflation. And so if you're right on inflation, you got a big leg up in forecasting Treasury bonds. And I think that we are in a period of easing inflation. Say not as quickly as some people had hoped, but I think we're on that path. And that's in my view, a strong reason for Treasuries, plus a safe haven. That it's probably the biggest safe haven investment instrument in the world.
Yeah. Well, also, you did call back in the early 1980s, you did call the bond a bull market, the bond rally of a lifetime, one of your 7 big famous calls. So,
no, I appreciate you remembering that.
Yeah. Well, I have a question for you, just as a millennial, and I talk to a lot of people on the show, and one of the things I am curious about, Dr. Schilling, is our debt situation here in the U.S. It crossed $34 trillion at the beginning of the year. How do you think about the debt situation? And this is like a really naive question, but does it matter, or is there going to be a point where it's going to matter? I'm just curious, like as a millennial, if it's something like my generation is going to have to deal with. Would love to hear your thoughts.
Well, we've done a lot of work on that and what we regard as a debt bomb. Now, the debt bomb, as I define it, is when the debt gets so big that the interest on the debt, which of course is a component of the deficit, simply multiplies and the whole thing grows geometrically. And that's the real risk. Now, we've never had one of those in this country. You've had it in countries like Argentina and so on, but we've never had one in this country. The closest we've come is where we are now, and that's pretty much equal to 1993. And that's a situation where the interest on the debt, and we look at it in relation to GDP. You've got to have a denominator there, a base, and it's about 3%. Now that was the greatest we had, to say, in the early 90s. We're back there. How big would that have to get before this thing really takes off? I don't know. But we're not there. We're not there yet. I'm no fan of government debt and deficits, but I got to tell you, I've been in this business a long time, as you can imagine, and people have constantly yelled and screamed about how the country is just going to go to hell in a handbasket because of debt. Now, one of the big problems, I think, with that is people confuse a family kind of situation with the national situation. And what I mean by that is this. People think about debt. Okay, you get a young family. incur a lot of debt. You're setting up a family. You're borrowing to buy cars, household furniture, houses, et cetera, et cetera. Okay. Then as people move on, their incomes go up. They start to pay down their debt. They accumulate assets. And at the end of the day, you hope they've got some net worth. That's a family. Now, people confuse that with the overall nation. Unless you think the country is going out of business, which I don't happen to, and I don't think you do either, then I don't think it's a parallel at all, because there isn't this situation where there's this kind of this Armageddon, this final day of judgment where you got to pay everything off or you're really out of business. There isn't that's not a very good parallel. What is a parallel, of course, is ultimately what is the confidence in the U.S. government and the Treasuries. And again, I'm no fan of debt and deficit because I think a lot of government spending goes for non-productive areas, and not nearly enough is channeled into things that are productive or left to consumers and business to spend their own money. But having said that, I just don't think that we have a situation where we're going to go out of business, and so to sort of say this is the end of the world. There was this, they had this concept that a few years ago is kind of faded now called modern monetary theory. It said it doesn't matter what the debt is, somebody always pay for it. Foreigners, right now it's individuals. Individuals are buying a lot of treasuries. Foreigners, not as many as they did earlier. But there still is, there is a lust for U.S. Treasuries. Like it or not, that's what people want.
Mm-hmm. Dr. Schilling, may I ask you one more question?
Why not?
Okay. All right. So for folks watching and listening, Dr. Schilling, you've made many great calls throughout your career, from the 1969 to 1970 recession, the early 1970s inventory bubble, the 1973 to 75 recession, the disinflation of the early 1980s, which led to that bond bull market, the bond rally of a lifetime call. You called the dot-com bubble. Also earlier, the demise of Japan's 1980s bubble, the dot-com bubble, the housing bubble, the financial bubble. And so my question for you is, I think the last time we talked, you're not a contrarian, but you do go against the consensus, and that is a key principle to making these big calls. Is there a bubble on your radar today that's going against the consensus that you could share?
And I appreciate your review of the good calls. You didn't mention the lousy ones. There have been a few of those. My approach is that, first of all, the consensus is paid to be bullish. Most people in Wall Street are, and I can tell you from my own personal experience, having been fired twice.
That's right.
By Merrill Lynch for being negative, even
by
though
Don
I was
Regan.
right. That's not conducive to employment longevity. So there's a tremendous bias to be positive, and so you only really can add value. And when you talk about adding value, you're talking about coming up with something that's not within the purview of the consensus, and ultimately being right for the right reasons. It's nice to be right, but it's nice to be right for some reasons that you foresaw. But it really means that you've got to look for the hidden flaws, because that's not the view of the consensus. So that's sort of explanation of my philosophy over a lot of years. Now, right now, what's there? I don't see anything that really ranks with the subprime mortgage bonanza we saw in the early 2000s, which just led to a huge thing. Now, commercial real estate is probably the biggest risk right now, and we're seeing the difficulties of empty office buildings. The occupancy rate's about 50%, and a lot of that is because, of course, people are at home. They're not going into their offices. The buildings are empty, and you have this a real pressure, and a lot of the borrowing that financed those buildings is coming due. And what happens? Well, the lenders don't want to renew them. So, as they say, they hand back the keys. The lender, in effect, is forced to take possession of a defaulted building. That's a problem, and it's already causing pain, and it'll cause a lot more pain. But it doesn't really rank with the subprime mortgage bonanza we saw starting in the early 2000s, when you had just almost everybody and his uncle was involved in that one. This is a much narrower focus. There's already a lot of blood on the floor. There's going to be a lot more, but it isn't enough to really risk the entire financial structure the way that the subprime mortgage was. And of course, that resulted in demand for massive bailouts by the Fed and other central banks and federal government. And that was as close as you could come to a financial meltdown. But I don't see that now. But commercial real estate certainly is an issue, and we're going to see increasing defaults. We're going to see increasing losses of lenders, and we're going to see increasing lack of zeal to finance this area. But there's plenty of capacity. I mean, you look at buildings, office buildings, half empty. There's no shortage of space.
Mm-hmm. Well, Dr. Schilling, before I let you go, take the last final moments here to let folks know where they can find you, support your work, and any parting thoughts, anything that we didn't bring up in this discussion.
I think we covered the universe here. Of course, always the interesting risk is that something comes up that you haven't thought about. But as I say, I've sort of made a career looking for the hidden flaws, and other than commercial real estate, I don't see any out there that are really all that problematic. Yeah, there's a lot of speculation out there. We talked about that earlier. The cryptocurrencies and the FSX and some of this kind of stuff. But again, I don't think that's enough to really risk the overall financial structure.
Well, Dr. Gary Schilling, president of A. Gary Schilling & Co., and also publisher of the newsletter Insight, which I will drop a link for folks to go to agaryschilling.com. And also be sure you can also call the toll-free number 1-888-346-7444. Dr. Gary Schilling, thank you so much for being so generous with your time, all of your knowledge and your wisdom. It has been an absolute pleasure having you back on the show. You are welcome on anytime.
I've enjoyed it, and I hope to come back sometime soon.
Well, we'd love that. Thank you again.